Welcome to Talk Tickers. We're breaking down the latest earnings calls. Today, it's all about Spok, the healthcare communications company. Now, they had a monster Q2, so the big question on everyone's mind was, could they keep that momentum going? Let's find out.
All right, here's how we're going to tackle this. First, we'll hit the headline numbers with the Q3 print. Then we'll dig a little deeper in behind the numbers. After that, we'll zoom out for the big picture, and finally, we'll give you our take in the next call, including our official rating.
Okay, so first up, the Q3 print. Even the CEO kicked things off by calling Q2 exceptional, which is kind of code for, hey, manage your expectations for this quarter. And yeah, the numbers definitely showed a bit of a cool down. So as you can see, the key metrics dipped a little compared to last year. Total revenue landed at $33.9 million. GAAP EPS, your basic profit per share, came in at 15 cents. And adjusted EBITDA, which gives you a good sense of their core profitability, was $6.6 million. It's a clear slowdown, no doubt about it, especially after the huge bookings they posted last quarter.
But here's the kicker, and this is really the most important takeaway from the initial numbers. Despite this softer quarter, management stood their ground. They came out and reaffirmed their full-year guidance. They're basically saying, don't worry about this quarter, our pipeline is so robust, we're still going to hit our annual numbers. That's a confident move.
So, let's peel back the onion here. To really get what's happening at Spok, you have to understand that you're looking at two totally different companies under one roof. It's this classic transition story playing out in real time. On one hand, you've got the software business. This is the future. It's growing, with managed services revenue up by triple digits. It's got a solid backlog, which means they know where future revenue is coming from. But on the other hand, you have the legacy wireless business. Yeah, we're talking pagers. It's slowly fading, but, and this is so important, it's a cash cow. It just prints money that they use to fund the software business. So the whole game for management is this delicate balancing act.
And this brings us to the moment on the call that made everyone sit up a little straighter. An analyst zeroed in on the ugliest number of the quarter, a massive 55% drop in high-margin license revenue. I mean, a drop that big, you just can't ignore it.
So how'd they explain it? Well, the CFO, Calvin Rice, basically said it all comes down to timing. He said license revenue is just naturally going to be lumpy. What he's saying is they had such a great Q2 because they pulled some deals forward, and some of the big deals they expected to close in Q3 just got pushed out to Q4. So, in their view, Q3 was just an awkward middle child between two really strong quarters. And they gave a little more color on that timing too. They mentioned that July started off pretty well, but then they hit what they actually called an air pocket. August and September just went dead. And it's exactly that kind of lumpiness, that unpredictability, that makes investors a little nervous.
Okay, so let's put the quarterly noise aside for a second and zoom out. Why do people stick with this story, even with the bumpy results? Well, it comes down to one thing. Their customer base is unbelievably sticky, and it is absolutely blue chip. This is their foundation. I mean, look at this. This isn't just a customer list, it's a competitive moat. Over 2,200 hospitals. They serve 18 of the top 20 adult hospitals in the country. We are talking about the absolute best of the best. Their tools are considered indispensable. These hospitals literally can't run without them. Plus, almost 80% of their revenue is recurring, and get this, they have zero debt. That's a fortress of a business model.
And the engine that's supposed to drive all their future growth is this, the Spok Care Connect suite. This is their big bet on an integrated software platform for hospitals. And they're not just talking a big game, they're putting their money where their mouth is, planning to spend over $12 million on R&D for this platform in 2025 alone.
So let's put it all together. You've got a lumpy quarter, a super strong underlying business, and management that's confidently sticking to its promises. So what's next? Let's get to the next call and our outlook. All right, here's our three-part forecast. Number one, we're expecting a big rebound in Q4. Management has to deliver on those deals that slipped from Q3. Their credibility is kind of on the line. Number two, we think the stock is probably going to trade sideways for a bit. The market needs to see a pattern of consistency, not just one good quarter. And number three, that brings us to our official rating.
We are initiating our coverage of Spok with a market perform rating. Really, it's a balanced story right now. You have a solid floor under the stock thanks to their guidance and that strong backlog. But at the same time, there's a ceiling on it, created by this lumpy, unpredictable execution. Until they can smooth that out, it's hard to see the stock making a huge move up. And as always, a quick but important reminder, this analysis is for informational purposes only. It is not financial advice.